Iraq, Iran, and Venezuela have all conducted oil sales in yuan. Each transaction chips away at the petrodollar system that has underpinned American financial dominance for half a century. China has also built alternative payment systems to reduce dependency on Western financial infrastructure. China's cross-border interbank payment system, CIPS, launched in 2015, and by 2023, connected over 1,300 financial institutions across more than 100 countries. Daily transaction volumes exceeded 380 billion yuan. While still dwarfed by SWIFT's $5 trillion in daily transactions, CIPS provides crucial backup. Countries worried about potential sanctions now have an alternative channel for international payments. Russia's use of CIPS surged after being partially cut off from SWIFT, demonstrating exactly why China built this infrastructure. Iran, North Korea, and Venezuela, all under various U.S. sanctions, have turned to CIPS for international transactions. Even countries not facing sanctions are integrating CIPS as a hedge against future geopolitical tensions. The digital yuan adds another dimension to China's currency strategy. Unlike cryptocurrencies, this is a central bank digital currency, fully controlled by the People's Bank of China. Domestically, over 260 million digital yuan wallets had been opened by 2023, with transactions exceeding 100 billion yuan. But the real strategic value lies in its international potential. China is working with multiple countries on cross-border digital currency projects. The M-Bridge initiative connects the digital currency systems of China, Thailand, Hong Kong, and the UAE, allowing instant cross-border payments without correspondent banks or dollar conversion. In pilot programs, transactions that normally took days and cost significant fees were completed in seconds for minimal cost. If this technology scales globally, it could make international transactions faster, cheaper, and completely independent of dollar-based banking infrastructure. China is also exploring digital yuan usage along Belt and Road countries, with pilots launched in several Southeast Asian nations. Is the yuan actually ready to be a true global reserve currency? Not yet. A reserve currency needs to be freely convertible, meaning anyone can buy or sell it without restrictions. The yuan fails this test. China maintains strict capital controls, limiting how much money can flow in and out of the country. These controls help Beijing manage its economy and prevent destabilizing speculation, but they make institutions nervous about holding large yuan reserves. What good is having yuan if you can't easily convert it when needed? China faces a fundamental dilemma here. Opening up capital flows would increase yuan internationalization, but could destabilize China's financial system, which carries enormous debt loads in local governments and state enterprises estimated at over $50 trillion. Beijing hasn't shown willingness to take that risk. There's also the question of trust and institutional credibility. Reserve currencies require deep, liquid financial markets where investors can park trillions safely. The U.S. Treasury market provides exactly this, with over $25 trillion outstanding and unmatched liquidity. China's bond market, while now second largest globally at around $20 trillion, lacks the same depth and, crucially, the same confidence. Investors worry about sudden government interventions and rule changes. The crackdowns on tech companies in 2021, wiping out hundreds of billions in market value overnight, reminded global investors that Chinese markets operate under different rules. When Beijing abruptly halted Ant Group's initial public offering, which would have been the world's largest, it sent a clear message that political considerations can override market dynamics at any moment. Financial institutions need predictability, rule of law, and protection of property rights. These remain question marks in China's system. Yet despite these limitations, yuan internationalization is measurably advancing. The currency's share of global payments has grown from less than 2% in 2015 to over 4.5% by late 2023. That might sound small, but it represents hundreds of billions in monthly transactions that previously would have been in dollars. The yuan is now the fifth most used currency globally, surpassing the Canadian dollar and the Swiss franc. In some regions, its influence is even stronger. In Asia, the yuan accounts for nearly 8% of payment transactions. Central banks worldwide are diversifying reserves, with yuan holdings in global reserves rising to nearly 3%, up from essentially zero a decade ago. Countries like Nigeria, Egypt, and Argentina have turned to yuan-denominated instruments to ease dollar shortages. Even traditional U.S. allies are participating in this diversification. France completed its first yuan-denominated liquefied natural gas transaction in 2022. Singapore has become a major offshore yuan trading hub, handling billions in daily yuan transactions. What's driving this isn't just Chinese pressure or propaganda. It's genuine demand from countries seeking alternatives and protection from dollar volatility. Emerging markets have repeatedly suffered from what economists call the dollar's exorbitant privilege problem. When the Federal Reserve raises interest rates to fight U.S. inflation, Capital floods out of developing nations, seeking higher returns in America, crashing their currencies and pushing them into crisis. This happened to Turkey, Argentina, Brazil, and several African nations in recent years. These countries had no say in Federal Reserve policy decisions made to address American economic conditions, yet they suffered severe consequences. The yuan offers partial insulation from this dynamic. If your primary trading partner is China and you can borrow, trade, and hold reserves in yuan, you're less vulnerable to Federal Reserve decisions made thousands of miles away for American interests. The geopolitical implications of this shift are profound and far-reaching. Dollar dominance has been a pillar of American global power for 80 years. It allows the U.S. to enforce sanctions effectively, turning economic pressure into a foreign policy tool. It enables financing of massive military expenditures cheaply because Treasury bonds are seen as the safest investment globally. It permits running persistent trade deficits without the currency crises that would cripple other nations. As the yuan provides alternatives, this power erodes incrementally but meaningfully. We're not heading toward a yuan-dominated world that simply replaces dollar hegemony with Chinese hegemony. The yuan has too many limitations, and China's economy faces too many challenges for that scenario. Instead, we're likely moving toward a multipolar currency system where multiple currencies share international roles. The dollar will remain dominant for years, probably decades, but it will share the stage with the yuan, the euro, and possibly digital currencies or regional currency blocks. This fragmentation creates both opportunities and risks. For businesses and investors, a multipolar currency world means new complexities. Companies will need to manage multiple currency exposures and navigate different regulatory frameworks. Banks will need infrastructure to handle yuan, digital currencies, and various regional payment systems. Hedging strategies become more complicated and expensive. But there are opportunities too. Countries and companies that master this new landscape can reduce transaction costs, access cheaper financing from multiple sources, and reduce vulnerability to any single country's economic policies or geopolitical whims. For ordinary people, especially in emerging markets, currency diversification could mean more stable prices and protection from the currency crises that have repeatedly destroyed savings in dollar-dependent economies. When a country's currency collapses because of dollar scarcity or capital flight, it's workers and savers who suffer most. Having alternatives could provide more resilience. Competition between currency systems might also drive beneficial innovation. China's digital yuan is pushing other central banks to accelerate their own digital currency research. The Federal Reserve, European Central Bank, and Bank of England are all exploring digital versions of their currencies. This could lead to faster, cheaper international payments that benefit everyone, not just large institutions. Competition might also impose discipline on policymakers. If the U.S. knows countries have genuine alternatives to the dollar, there might be more restraint in weaponizing the financial system for political ends or running unlimited deficits without consequences. The path forward isn't predetermined or smooth. China faces serious economic headwinds that could derail UN internationalization. The country is experiencing demographic decline with a shrinking working-age population. The property sector, which accounts for roughly a quarter of Chinese GDP, is in crisis with major developers like Evergrande defaulting on hundreds of billions in debt. Economic growth is slowing from the double-digit rates of previous decades to more modest levels. Youth unemployment has reached concerning levels. These domestic challenges could force Beijing to prioritize stability over currency ambitions. Meanwhile, the dollar benefits from powerful network effects, where its dominance is self-reinforcing. The more people use dollars, the more valuable it becomes to use dollars. Habits and infrastructure built over 80 years don't change overnight. American financial markets remain the deepest, most sophisticated, and most innovative globally. U.S. institutions, for all their flaws and recent challenges, still inspire more confidence than alternatives when global crises hit. During the COVID pandemic and the financial crisis of 2008, investors fled to dollar assets as safe havens. The dollar's share of global reserves, while declining from over 70% 2 decades ago, still hovers around 60%. What we're witnessing is a slow-motion transformation of the global financial architecture. It's not dramatic or sudden. There won't be a single moment where we wake up and the dollar has been dethroned. Instead, year by year, transaction by transaction, policy by policy, the yuan and other alternatives carve out larger roles. Countries build redundancies into their financial systems. New payment networks emerge and gain users. Digital currencies create possibilities that didn't exist before. The unipolar financial world centered on the dollar and American institutions gradually becomes multipolar, more complex, potentially more resilient, but also more fragmented and harder to govern. International cooperation becomes more challenging when there's no single dominant currency and clearing system. The unseen power of the yuan lies not in replacing the dollar, but in providing choice where none existed before. And in geopolitics and economics, having options is power itself. The question is not whether the dollar will fall, but whether the world is prepared for what comes after absolute dollar dominance ends.